Hi, I'm Dennis from Accountant's Desktop. This video will demonstrate our latest tax planning workbook, which for non-subscribers is available for purchase as a standalone calculation. You can view any specific part of this video by using the links below to jump straight to that section. If you like this video, please give it the thumbs up below, and don't miss any of our future videos by clicking on the subscribe button. Tax planning is an essential part of services provided by an accounting practice. Clients expect their tax advisor to be proactive, and they want to pay the least amount of tax that is legally possible. In our solution, you commence the process by pasting a profit and loss report for the year to date into the workbook. When the report has been prepared by your client, you then make any necessary adjustments to arrive at a true profit. You then project that year-to-date profit to the end of the financial year using one of three options. With that projected annual profit, you can then add reconciliation adjustments for the tax return to arrive at the taxable or net income. This fifth step is where you add details of tax planning measures to reduce the client's projected taxable or net income. Where a particular measure involves a deductible payment to a related party, you can enter their other income to calculate the tax effect for the group as a whole. And with additional super payments for associates, contributions and, if applicable, Division 293 tax will also be accounted for. And finally, if the client is a partnership or trust, you add the names and other income of partners or beneficiaries and project distributions. This table will display their marginal tax rates and the amount of income available at those rates. Where the client is a discretionary trust, you can then project tax-effective distributions utilising the lowest marginal tax rates first. Let's take a look at an example for a company client. This is the home screen in our calculator. There's a fixed pane on the left-hand side of the screen with a summary of all calculations and links to the details which will appear on the right-hand side of the screen. At step 1, you've pasted a profit and loss statement for the year-to-date prepared by your client and entered data for date 2, report source, client entity type, and net profit for that period. In the profit and loss statement, your client has shown a director's loan as income and BAS payments as an expense. These amounts are entered in the relevant schedules for step 2 to arrive at a real profit for the year to date. At step 3, you project the profit to the end of the financial year using one of three options. At the first option, the spreadsheet will annualise the part-year profit. At the second option, you enter details of each income and expense item for the remaining period. And at the third option, you enter a summary of the total income and expenses for the remainder of the period. For the purposes of this demonstration, I've selected the first option. At step 4, you enter tax reconciliation adjustments. In our example, I've added back depreciation in the accounts and shown depreciation for tax purposes to arrive at a projected taxable income. So at step 5, you explore some tax planning measures. Before tax planning, the projected taxable income and tax payable is shown on this screen. You propose to purchase some much needed equipment that can be written off, pay bookkeeping fees to a director's partner, write off a bad debt, and make additional super contributions for each of the two directors. The tax summary at the right-hand side of the screen shows the changes in the client's taxable income and tax payable. However, tax on assessable payments to the director's partner and tax on additional super contributions need to be taken into account to calculate the amount of tax either saved or deferred. Step 6 applies to partnerships and trusts, so we'll take a look at that scenario now. Let's assume the same profit and tax planning measures as in our company example, but with the business structured as a discretionary trust. The tax planning table now shows undistributed profit. So you go to the partner and beneficiary distribution table to enter those details. At this table, you enter the names of the beneficiaries of the trust, select their taxpayer type, and enter their other income, personal deductible super contributions, and if applicable, other income for Division 293 purposes and offsets and credits. The first thing to notice is the marginal tax rate for each beneficiary and the income available at that rate alongside. Using that information, you can distribute the profit in a tax-effective manner using up the lowest marginal tax rates first. Back at the tax payable summary at step 5, You can see a comparison of the tax payable before and after implementing your tax planning measures and the amount of tax saved or deferred. Of course, the ATO would expect any distributions to beneficiaries to be actually paid. Thank you for watching this video. Don't forget, if you like the video, please give it the thumbs up below, and don't miss any of our future videos by clicking on the subscribe button. My details are shown on the screen, so please feel free to contact me for any further information.